In this video, we are going to talk about dividends. So before starting this video, please like this video and subscribe to this channel for our future updates. What is a dividend? A dividend is the distribution of some of a company's earnings to a class of shareholders as determined by the management board of the company. Common dividend-paying shareholders are typically eligible as long as they own the stock before the ex-dividend date. Dividends may be paid as cash or additional stock. Understanding dividends. Shareholders must approve dividends through voting rights. Although cash dividends are most common, dividends can also be issued as stock shares or other property. Various mutual funds and exchange-traded funds, ETF, also pay dividends to companies. A dividend is a token reward paid to shareholders for investing in a company's equity, usually from the net profits of the company. While the majority of profits are held in the company as retained earnings which represent the money to be used for the ongoing and future business activities of the company, the remainder can be allocated to shareholders as a dividend. Sometimes companies can still make dividend payments even if they don't make adequate profits. They may do so to maintain their track record of regular dividend payments. The board of directors can choose to issue dividends over different timeframes and payout rates. Dividends may be paid at a scheduled frequency, e.g. monthly, quarterly, or annually. Walmart Inc., WMT, and Unilever, all, make regular quarterly dividend payments. 233 companies can also issue special dividends individually or in addition to a scheduled dividend. Backed by strong business performance and improved financial outlook, Microsoft Corp. MSFT, declared a special dividend of $3 per share in 2004, well above the usual quarterly dividends of 8 cents to 16 cents per share. Dividend-paying companies. Backed by strong business performance and improved financial outlook, Microsoft Corp. MSFT, declared a special dividend of $3 per share in 2004, well above the usual quarterly dividends of 8 cents to 16 cents per share. 4 dividend-paying firms. Larger firms with more predictable profits are often the best dividend payers. These companies tend to issue regular dividends as they seek to maximize shareholder wealth beyond normal growth. Companies in the following industry sectors maintain regular records of dividend payments: basic materials, oil and gas, banks and financial, healthcare and pharmaceuticals, utilities companies structured as master limited partnerships, MLP, and real estate investment trusts, REIT, are also top dividend payers as they require specific distributions to shareholders. 5/6 funds may also issue regular dividend payments under their investment objectives. Startups and other high-growth companies, such as technology or biotech companies, may not offer regular dividends. Because these companies may be in the early stages of development and may incur high costs, as well as losses, attributable to R&D, business expansion, and operational activities, they may not have sufficient funds to issue dividends. Even early to mid-stage profit-making companies avoid paying dividends if they aim for higher than average growth and expansion, and want to return their profits to their business rather than paying dividends. Important dividend dates. Dividend payments follow a chronological order of events, and the associated dates are important to determine the shareholders qualifying for dividend payment. Announcement date. Company management announces dividends on the announcement date and must approve the shareholders before they can be paid. Ex-dividend date. The date the dividend eligibility expires is called the ex-dividend date or the ex-date. For example, if a stock has an ex-date of Monday, May 5th, then shareholders buying the stock on or after that day will not qualify to receive the dividend as they buy it on or after the expiry date. Shareholders who own the stock 1 business day before the ex-date, i.e. Friday, May 2nd, or earlier, will receive the dividend. Record date. The record date is the company's cutoff date to determine which shareholders are eligible for a dividend or distribution. Payment date. The company issues the dividend payment on the payment date, which is when the money is credited to the investor's accounts. Since dividends are irreversible, their payments typically lead to money leaving the business books and accounts forever. Therefore, dividend payments impact share price. At the opening session of the ex-dividend date, it may rise approximately by the amount of the dividend declared and then decline by a similar amount. A company trading at $60 per share, for example, declares a $2 dividend on the announcement date. Once the news becomes public, the share price shoots up to around $2 and hits $62. Say stock trades at $63 a day before the ex-dividend date. It's adjusted by $2 on the ex-dividend date and starts trading at $61 on the ex-dividend date at the start of the trading session because anyone buying on the ex-dividend date won't receive the dividend. Please note that the only guarantee is price adjustment lowering the share price by the dividend on the ex-dividend date. Why companies pay dividends? Companies pay dividends for various reasons. For investors, these reasons can have different implications and interpretations. Shareholders can expect dividends for their trust in a company. Management may aim to honor this sentiment by providing a robust track record of dividend payments. Dividend payments reflect a company positively and help maintain the trust of investors. Shareholders also prefer dividends because shareholders in many countries treat them as tax-free income. Conversely, capital gains made by selling a share whose price has risen are considered taxable income. Traders seeking short-term gains may also prefer dividend payments offering instant tax-free gains. 7. A high-value dividend statement can indicate the company is doing well and has generated good profits. But it can also indicate that the company has no suitable projects to generate better future returns. It uses its cash to pay shareholders instead of reinvesting it into growth. If a company has a long history of dividend payments, a reduction or elimination of the dividend amount may signal the company is in trouble. The announcement of a 50% drop in dividends from General Electric Co. GE, one of America's largest industrial companies, was accompanied by a more than 6% drop in GE's stock price on November 13, 2017. 8. Reducing the dividend amount or deciding not to make any dividend payment may not necessarily translate into bad news about a company. Management of the company may have better plans to invest the money, given its financials and operations. For example, a company's management may choose to invest in a high-return project that has the potential to magnify long-term shareholder returns as compared to the small gains they will make through dividend payments. A note about fund dividends. Funds paid dividends are different from companies paid dividends. Company dividends are usually paid from profits generated from corporate operations. Funds work on the net asset value principle, NAV, which reflects the valuation of their holdings or the assets that a fund may track. Since funds have no intrinsic profits, they pay dividends from their NAV. Due to NAV-based fund work, regular and high-frequency dividend payments should not be misunderstood by the fund as stellar performance. A bond investing fund, for example, can pay monthly dividends as it receives money in the form of monthly interest on its interest-bearing holdings. The fund merely transfers income from interest wholly or partially to fund investors. Also, a stock investing fund can pay dividends. Its dividends may come from the dividends it receives from stocks in its portfolio, or by selling a certain amount of stocks. The investors receiving the dividend from the fund are likely to reduce their holding value, reflected in the reduced NAV on the ex-dividend date. Are dividends irrelevant? Economists Merton Miller and Franco Modigliani argued that a company's dividend policy is irrelevant and has no effect on a company's stock price or capitalized cost. A shareholder may theoretically remain indifferent to a company's dividend policy. For high dividend payments, they can use the cash received to buy more shares. Reinvesting dividends is often a smart choice, though not always the best. For example, in low payments, they can instead sell some shares to get the cash they need. In either case, the combination of a company's investment value and the cash they hold will remain the same. Miller and Modigliani conclude that dividends are irrelevant, and investors shouldn't care about the company's dividend policy since they can synthetically create their own. However, in reality, dividends allow money to be made available to shareholders, which gives them the liberty to derive more utility out of it. They can invest in another financial security and reap higher returns, or spend on leisure and other utilities. Additionally, costs like taxes, brokerages, and indivisible shares make dividends a considerable utility in the real world. Dividends can help to offset costs from your broker and your taxes. Ultimately, this can make dividend investments more attractive. Of course, to get invested in dividend-earning assets, one would need a stockbroker. Buying dividend-paying investments. Investors seeking dividend investments have some options including stocks, mutual funds, exchange-traded funds, ETFs, and more. The dividend discount model or the Gordon growth model can help choose stock investments. These techniques rely on anticipated future dividend streams to value shares. To compare multiple stocks based on their dividend payment performance, investors can use the dividend yield factor, which measures the dividend in terms of a percent of the current market price of the company's share. The dividend rate can also be quoted in terms of the dollar amount each share receives dividends per share, DPS. In addition to dividend yield, another important performance measure to assess the returns generated from a particular investment is the total return factor. This figure accounts for interest, dividends, and increases in share price, among other capital gains. Tax is another important consideration when investing for dividend gains. Investors in high tax brackets are observed to prefer dividend-paying stocks if the jurisdiction allows zero or comparatively lower tax on dividends than the normal rates. For example, Greece and Slovakia have a lower tax on dividend income for shareholders, while dividend gains are tax-exempt in Hong Kong. What do you think about our video? Are you planning to invest in a stock? Let us know in the comments below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.